Today we're going to be breaking down the bear market price action to discover exactly what's going on and what needs to change going forward. At the end of the video, we're going to reveal the one technical tool that has continued to work despite the heightened volatility. So let's start with drawdowns. As we know from the high in February through the intraday low on Monday, April 7th, the S&P 500 fell over 21%. So whether you want to measure this in terms of a bear market, 20% from close to close, intraday, so forth and so on, I think we can understand one concept. It's the fact that what we're seeing is bear market price action. Doesn't matter if we are down just a few percent from the top or much more. Recognizing that and understanding the strategies that we need to use because of it is the most important thing. And it's been, of course, even more severe since the tariffs were announced, right, down about 17% from the high, right? Just talking about a number of days now. So we know that that's an accelerated move and it's really changed things. And just sitting through some of these trading days, of course, has been extremely hectic. And so looking at this more closely for the short term, these are the same percentage terms, just on a zoomed in basis using this 2-hour chart. And again, looking at the 14-period RSI down here. So not surprising, the extreme weakness we've seen over the last few days has caused the short-term RSI to hit extreme levels on the downside, hitting 13, which we haven't seen really since February and March of 2020. And we know that the S&P was down 35% in a matter of 6 weeks, turn on a dime. And of course, we know the rest. So we started talking about this, noticing the change really from the beginning of the year, because when we saw the market come back from dips from the October 2023 low, we routinely saw two things occur. One was that each of the ensuing rallies were able to push the 14-period RSI back to overbought territory. We know that didn't last, but those rallies were strong enough to pull the indicator back to that threshold, which showed that momentum was back on the positive side. And most of those times, that resulted in new highs as well. And we had to wait a little bit longer during the biggest downturns, especially from July and August. But because of that move from that low was so strong, right? 1% gains to close out that month, we did get that new marginal high soon thereafter. And so looking at the periods when that did not happen, when the rallies faded, or when the rallies weren't strong enough to pull the RSI back to overbought territory, led to further down legs. We saw it right here at the end of July, August, right? Looked like the pretty good move initially. That, of course, was faded right as August began, and we know that that was a very strong downturn. Saw it again most recently at the end of December, early January, right? 2 rally attempts, both created only lower highs, which led to another down leg. And the ensuing rally was better, got us back to new all-time highs, gave us a slight overbought reading. But then the next time we had a new high or a new breakout to new highs above 6,100, that did not produce another overbought reading. And we were waiting for that to occur. You go back in the last 2 videos, we've mentioned this almost every single time, saying that the rallies weren't strong enough to produce this overbought reading, which then, of course, led to more downturns and declines, which just became more severe as things progressed. And so we're still waiting for that to happen now. And really, if you think about it, maybe we shouldn't even do anything on the buy side until we finally see at least an overbought reading on a short-term basis. Think about the swings we've just seen over the last few days, right? 5-6%, even more for some of the stocks. None of them were strong enough to get this RSI on a 2-hour basis to overbought territory. And so it's not about catching the low. It's about trying to understand where the best time to buy is when momentum is actually turned. So that continues to be a waiting game for now. And so over the last few days, the number of new 52-week lows have spiked as well, over 130 on both this past Friday, April 4th, and of course Monday, April 7th as well. And it's just something we haven't seen much over the last 20 years going back to 2005. And the ones that we did, of course, coincided with the biggest market corrections and or bear markets that we've seen. And so one thing we have to pay attention to going forward is we may get more of these just because the market continues to be near its most recent lows, same with many of the stocks. And so that number may grow, as we can tell during the great financial crisis, over 80% of the index at its worst, right, toward the end of 2008, over 400 names hit new 52-week lows. That was extreme, but even other periods got much more than 130. So that may happen, but the bigger variable to look for is seeing if we get clusters of 100 stocks or more making new 52-week lows. As we can tell here, the biggest clusters, or the greatest amount of days when we had more than 100 stocks make new 52-week lows, just coincided with the worst markets, bear market, great financial crisis, and again 2022. The others were difficult to deal with. COVID down so much in a short amount of time, 2011, 2015 to 16, but overall, they don't compare to the biggest and longest bear markets. And we can just know, just by tracking this number, how bad it is and how long this will potentially last. So think about the reverse. If we start to rally and then the pullbacks are not strong enough or not bad enough to pull most of the S&P 500 stocks back down to new lows, that could be a positive divergence, right? Just say that technology continues to lag, but the rest of the market is doing okay, and we'll see that reflected in how the stocks do versus their new lows. Okay, so of course, last week, there were some big down moves. Thursday and Friday, both down more than 4%. So Wayne and Whaley, of course, does outstanding work. And this is one of the studies that he did recently. And it shows that we had 2 4% down days in 1 week and also 2 consecutive negative days of at least 4%. Going out a year, the numbers are pretty good, right? Of course, no surprises. Look at where they happened. Now, this table gives us a lot of information. Number one, it just occurred in 2025. Look at the times when it happened in the past. Not much at all. 1987. Numerous times. 2008, 2009. No surprises. 2011 and 2020, right? So there's some of the biggest corrective periods we've had over the last few decades. And so almost every one of them had a very good return 12 months later, sometimes even 6 months later. But the most important part about this, which other studies sometimes don't show, is what could happen along that path. And along that path, he shows the max drawdowns along the way. And we know that things started to fall apart soon after the S&P made a new all-time high and failed in late 2007, and then started this downtrend that just picked up steam to the point where things really got out of hand in September, October, November later that year. And so a year later for all those, very good, or at least not bad, but it still had to endure additional 20-25% drawdowns along the way. And so you think about why that occurs. You have a huge volatility event, you typically don't see an immediate buying opportunity that then takes you straight up from that point. Every time is different, of course. The S&P could be up 12 months from now, 2 years from now, 5 years from now. We have to understand that the track to get there is probably not going to be an easy one or a simple one to navigate. And so we also had the S&P drop 9% last week again. Hasn't happened a lot. Going back 50 years, we can see pretty clearly the periods that it did occur in. Again, the biggest bear markets that we've seen. The 87 crash, or the internet bubble bursting, 2000, and then late 2001, middle of the great financial crisis, COVID crash and comeback, and now what we're dealing with over the last few weeks. So what this shows us is that 9% down weeks don't last, but they do happen in bear markets, and bear markets can be pretty quick, historically quick, like we saw in COVID, or drawn out, like we saw, of course, from the internet bubble bursting, considering that this particular unwind is being led by large cap growth and was even before all the tariffs were announced, is something that we have to keep in the back of our minds as we continue to progress. And so looking at the weekly channel we've been talking about, all on the way from the October 2022 low, the S&P did a very good job staying within the channel, right? Basically, ebbing and flowing along the way. We know that when the S&P got overextended, it was a good time to sell, or at least expect a pullback. When it did pull back to the point where it got either back to this lower level or undercut it, it was a very good time to deploy more capital. In fact, from the October 2023 low, we can see that those pullbacks didn't even get much below the middle line, right? So that's how minimal those dips were, how eager traders were to buy that dip, and how immediately those efforts were rewarded, which of course that has completely been shattered now. So we have to understand, yes, looking at a long-term, multiple decades, still much higher, still an uptrend, but we knew that at some point, the strong move over the last 2 or 3 years was going to, at the very least, change, if not end. And of course, that's been emphatically displayed over the last few weeks. So with all that being said, we have seen 2 signs of potential capitulation over the last few days, which we'll see if they can lead to anything more than just these strong intraday bounces that have been wasted so far. So the first thing is that we finally saw some support come back into the picture. We know on Monday, April 7th, the S&P gapped extremely lower, got to a low of just about 48.20, right? So look back to that. It's very close to the high from late 2021. I think everyone understands that. It also is the 50% retracement of the entire rally from the October 2022 low. And now it's the relative low point of this move for now, right? And so that continues to be a line in the sand. Support is more than a point. It's a zone. And so the market may need to go back below that more, undercut it by 1%, 2%, 3% more. But anywhere in this zone is at least a spot where we can identify some areas of demand where on the way down, these other lows could have been those spots, but the way that it played out, there was no stopping those sell-offs, and there was no indication of any two-way interest, meaning buys, the demand did not come into the picture. And whether what we've seen over the last few days or short covering or actual buyers trying to identify a spot for at least a trade, that's at least step one. Even in 2022, there were plenty of times when we saw really strong efforts, and we know those bear market rallies were substantial. So I think that you've seen both of those things happening over the last few days, with the hope, of course, is that one of these days, their buy efforts will be rewarded for more than just a few hours at this time. For now, that hasn't been the case. And so with the VIX as well, we know really elevated, and in just over a week's worth of trading, the VIX was up 260% at its high from this past Monday, which is not quite as much as we saw from the move from July to August, 320%, but of course, extremely different than what we've seen over the last number of months. And so the key in August, as we know, was that despite being up that much, it was instantly reversed, right? And the VIX closed much lower than that on the day, and that gave way to the huge amount of demand we saw again in the ensuing days, which then led to a much bigger advance over the next few weeks and into the next few months, right? And so seeing the VIX get up to that point, in both in terms of levels in the 60s, and again in terms of how much it went up just over the last few days, coinciding with the fact that the S&P got down to that 4,800 support zone, those are all reasons to see that huge reversal. But so far, it is not like what we saw in August, where we've seen a lot of upside follow through just yet. And of course, much more information to contend with, which is the major reason for what has been going on. And so with all that, one thing still hasn't changed in 2025. You probably know what that is. That patterns continue to work. In particular, bearish patterns are working. Surprise, surprise. But you think about it. Bullish patterns were working before, and as they did, it confirmed the uptrend. Bearish patterns are working now, and it's confirming the downtrend. We also get a lot of feedback when we see patterns fail, both bullish and bearish. We saw bearish patterns fail on the way up. Now we're seeing bullish patterns fail. So they can't work together. Maybe on the short term they can. You don't see many bullish patterns even take shape in the most volatile trading environments. They did every so often in 2022. When they formed, it took over weeks to see it, and they were very big. And by the time we saw a potential breakout happen, that's when the market started to pull back once more. Our first indication of a character change was back in December, and we reviewed this in the past. That was the first time that we saw a bullish pattern fail. It was a small inverse and shoulders pattern, as we can see here. Again, we got a few days of follow through and it failed. So it was something that we noted, didn't put too much weight on it only because it was a small pattern, but check the box because we just hadn't seen that type of action where every consolidation, for the most part, led to an upside resolution. So the market then took its time, consolidated more, and we finally got a much bigger version, right, with a breakout to new all-time highs, which produced that 64.25 target that lasted, as we know by now, only a few days, and the bottom fell out. And so that looks like this on a much larger scale, where this potential breakout that we had at the beginning of February 2025 looked very similar to the biggest bullish patterns that formed over the last year, which of course led to upside follow through with our targets hit as well. So this is much different. And as we can tell, as the market started to fall apart, volatility just became extreme to the point where it's been doing what we've seen over the last few days, which is historically extreme at this point. And so as that was happening, or as we saw those bullish patterns start to get negated, some bearish patterns started to pop up. And the first one that gave us a downside target of 56.50, which was acquired in the early stages of March. And that brought us all the way down to 5,500 as March began, then led to the first time we saw demand surface once more, which then formed another bullish pattern, another nominal follow through seen here on a 2-hour basis. That was then negated, then gave way to two more bearish patterns, right? The first one was hit just last week, 51.90, this head and shoulders pattern, relatively small in terms of what it looks like, but of course it had a pretty substantial downside target. And on Monday, April 7th, with the gap lower down to 4,800, the bearish flag pattern that we had noted was developing in March also hit its target of 5,025, right? So 3 straight bearish patterns to start the year. It just means that we have to be prepared to see more of those. Now, at the moment, because there's been no semblance of bullish patterns being formed, of course, and now all our downside targets have been hit from the bearish side, there's a jump ball, if you will. The next construction of a pattern, at least on a short-term basis, could be bullish, could be bearish. But as we can tell, over the last few days, it's going to be difficult to identify some sort of bullish pattern if these daily ranges continue to be that severe. But we'll continue to look for them because, again, that will be the first step in eventually getting back to a more positive trend, which of course doesn't sound likely at this point, but we know things can change. And so that's the positive. Now, the concern with all this is that the market continues to be under pressure, and then we can look to this as potentially forming an even bigger bearish pattern. So right now, something like this could be under construction. Again, depending on what type of rally we continue to see or not see around this 4,800 area, this could look different. This neckline could be then downward sloping, but we can tell what this looks like, right? This is a left shoulder. This is the head, some sort of right shoulder, whatever it looks like. Maybe another bearish flag being formed, but underneath this zone, there's a whole other air pocket. And so again, we just have to understand that that's there. Whether that develops into a bearish pattern and an aggressive downside target remains to be seen, but we can't discount any scenario, both up or down. Okay, so now that we went through what a bear market looks like, you're going to want to understand what the signs are for a bottom to form. Because if you ignore those signs, you won't be ready for the next up leg. So I urge you to check out this next video, 7 steps for a new uptrend.